morning, ladies and gentlemen, and good afternoon to those who have connected with us from the Far East. Thank you for connecting with National Development Bank PLC's Investor Webinar, discuss the financial performance for the first half ended 30th June 2022. Today's webinar will take the same format like the prior webinars, where our Director and Chief Executive Officer, Mr. Himantha Seniviratne, will take you through a prepared presentation. At the end of that, the forum will be open for questions from all of you. We invite you to use the chat option to pose your questions to the Q4 or anyone else in the panel. With that note, now over to Mr. Himantha Seniviratne. Thank you.
Thank you. Good morning, all. Welcome to the NDB's investor update for the first half 2022. And good afternoon to those who are joining from the Far East. Let me take you through the presentation as usual. And with me, I have the senior leadership team members with me in case there are any questions to chip in. Sanjay, who's heading Senior Vice President, Personal Banking; Deepal, Chief Operating Officer; Suendini, Vice President, Finance; Niran, Vice President, Treasury; Indika, Vice President, Business Banking; Ishani, Vice President, Project Finance; Vinod, Vice President, Corporate Banking; Zian, Vice President, Branch Network and Retail; Tamita, who is Assistant Vice President, Digital Financials; and Shankar, who is Assistant Vice President, Corporate Planning. So those are with me, but they will of course come in if there's any further questions to clarify. And with that introduction, let me take you through a very quickly corporate profile. I think all of you are quite aware. I think they have been in the banking industry for 40 plus years. And now the fourth largest listed bank in Sri Lanka, operating with 113 branches, 150 plus CRM and ATM machines, and also the group synergies that we bring in through the NDB investment banking, the wealth management, the stockbroking arms, all that helps us to get the group synergies and provide the best customer-centric solutions to our customers. And recently, I think we have been winning some prestigious awards, the latest being Euromoney Best Bank in Sri Lanka Award for 2022, and also the Global Finance USA's Best Bank in Sri Lanka for 2022 and for the last 4 years consecutively, and also the Banker, the Best Bank Award. So that's all thanks to the service that we deliver, thanks to our stakeholders, customers, staff, everybody. Just want to acknowledge that. And let me now move on to the part one on the financials. Prior to that, just want to brief you about the operating environment, what we went through in the first half. The period we are discussing is from January to June. So this is, I must say, the most challenging environment that the banking sector has faced. You all are aware that the monetary policy tightening was happening the first half, and there was more than 8.5% or 850 basis point increase in SDFR the rates. And another thing was that the rupee that had been pegged $2 for almost 10 months, artificially at about 200 level, was allowed to be free floated. That basically moved the rupee from 200 to 360 rupees, which was stabilized around 360, 365 range. So actually two things that impacted the entire banking sector and the economy. One is on the interest rate, sharp hike in the interest rates, and on the other side, the exchange rate, significant depreciation of the rupee. We also saw restrictions on importing goods that affected the importing customers, and also the exporters to a certain extent who are reliant on some of the import raw materials. And we also saw the power outages, fuel shortages that all continued to a level that people couldn't tolerate anymore. That also saw the lot of changes, the political changes that we have seen. Apart from that, the government in August also announced our inability to make the international debt payments on time. So as a result, the sovereign rating also downgraded by the international rating agencies. Then we also saw the inflation picking up very sharply, especially the food inflation around 80+ range, and even the core inflation more than 50%. So all the worst situations that we can expect, all that happened within the last 6 months. So the bank operated in that circumstances, in that environment. So that is a key environment that we should all be aware of. I just want to remind all our investees who are here, just to give a little background of that, the challenges that we went through. So the standing deposit rates and all, you would see that from last year, August 2021, bank rate 9 went up to 18.5. SDF rate from a 5%, 14.5. So almost 100,000 basis point or 10% increase in the SDF rate. If you look at from August 2021 to July 2022. But first half, as I mentioned, about 8.5% increase. So despite all that, this is the financial summary at very high level. Later on, I will explain in more detail. Despite all that, the operating profit, operating income level, NDB managed to record a 46% year-on-year growth to 22.4 billion. So that's actually, I would say, a tremendous achievement in this environment, whilst maintaining the service level, ensuring that the core operating income growing year on year. However, on the other side, the impairment charges were substantially increased. So it was 13.9 billion, more than 235% growth in impairment, again year on year basis. That led to the 56% year on year drop in profit before tax, which was recorded at 2.7 billion, and the profit after tax at 1.7 billion. So naturally, the profits are moderated, mainly because of the increasing impairment charges. Otherwise, the top line level close to 50% year-on-year growth. Balance sheet also had substantial growth, 16% for the first half. Now we are at 816 billion. Partly due to the steep depreciation of Sri Lankan rupee as well, the dollar denominated assets were actually valued at rupees at a much higher pace. So that's one reason. But there was some growth in the first quarter in the loans as well. So loan book grew by 16% to record 609 billion, and deposits grew by a higher percentage, 17%, to cross at 645 billion. So the deposits are more than adequate to support the loan growth, 645 deposits versus 609 billion loans. In terms of group performance, group profit after tax was 1.7 billion year on year, as I mentioned, 58% drop. Group ROE again significantly dropped from what it was last year, from 12.4 to 5.3. Group total assets are at 822 billion. And we also saw the margins improving thanks to the rating hikes. So it's that at asset level, the NIM is 3.78% compared to 3.25 in 2021. And also in terms of credit quality, the impaired loan stage 3 ratio was at 5.7. In terms of capital ratios, capital adequacy, we managed to still keep above the minimum requirement of 8.5. At 8.63, capital adequacy ratio CR1 of 8.63. I must say that this is without capitalizing the retained profits. I would say most banks, we saw they having interim audit in June to take the reserves. However, we have not taken that into our capital. So this 8.63 is without taking the retained earnings of 1.7 billion to the capital. But if I have taken that, this capital ratio would have been 9%. And the total capital ratio was 13%. Had we taken the retained profits, it would have improved to close to 14%. So that's a very high level summary. Moving on to the part 3, which is the financial performance, the income statement. You would see that gross income level, 46% increase in the gross income from 30 billion to 44 billion. And mainly coming from interest income, which grew by 46% again, from 25 billion to 37 billion. Interest expenses are also similar level. However, the net interest income was 14.9 or almost 15 billion compared to 10 billion in the first half last year. So that's about 45% growth. We also had good growth in net fee and commission income year on year, again, close to 19% growth from 2.5 billion to 3 billion. This is despite the import restrictions that we saw in the first half, the fee income going. One is the trade income, certainly that contributed. In addition to that, the digital strategy that we deployed, the key income from that side, and also the cards and some of the other retail products also contributed to get the fee income growing despite the restrictions that were introduced latter part in terms of imports, etc. Total non-fund based income also we have saw 77% growth from 2.4 to 4.3, and overall total operating income we had 46% growth from 15.3 billion to 22.3 billion. So as I said, the key driver of the profitability later on to reduce the profitability was the impairment charges, and we were compelled to take high impairment charges, especially after the country rating was downgraded. So from 4 billion last year first half, we ultimately ended up in taking 13.9 or almost 14 billion impairment charges. So that's about 235% increase, mainly coming from both the investment in government securities, both foreign currency denominated, and also the loan book precautionary provisions that we took. And we continue to ensure that the impairment cover is built up, especially in an environment like this where we see a credit side also naturally with high interest environment. Some of these SME sector and even some of the corporate sector also find it difficult to manage that and also continue their business as they used to do when the economy has also contracted, the GDP has contracted in a scenario. So that would be an area that we would be focusing even in future to build up that adequate impairment cushion. So that that's what we did in the first half as well. So impaired loan stage 3 ratio has moved up to 5.7% from 4.5 last year. However, the impairment cover remains same, almost at 32% compared to last year. With regard to operating expenses, despite the inflationary pressure, all the increases that we saw, I think the team has done a wonderful job in containing that to 13%. So compared to first half last year, 5.1 billion, the operating expenses growth was 13% to record 5.7 billion. Even in the personal expenses side, we have more than 3,000 staff with us, but managed to contain the personal expenses at 5%. Naturally, I would like to thank the staff also for supporting all that. Our efforts in controlling the expenses wherever possible, bank try to manage our costs, controllable costs. The other expenses, of course, a steep increase from 1.8 billion to 2.4, mainly due to the depreciated rupee-related expenditure and some other IT commitments which are paid in dollars, especially for the core banking and those systems. The licenses and all are paid in dollars. So that impact came in the second half, rising the other expenses. But despite all that, 13% increase in operating expenses, when you compare with most of the other banks, I think we have done a reasonably good job, leading to a cost-income ratio below 30%. That reflects both the cost efficiencies and the revenue enhancement. I think that's a remarkable achievement. Despite all these challenges, cost-income ratio below 30, and that would be one of the key driving points for NDB as well. Even in challenging situation, how you manage is how efficient that in terms of you manage your cost, and how nimble and how efficient and how adaptable you are to a situation. And that's where NDB would score even in future. In terms of profitability, as I mentioned, the profit before all taxes, because of the high impairment charges, dropped by 56% from 6.9 billion, 6 billion last year first half to 2.6 billion. Of course, with the VAT component and all, the profit after tax, 57% drop from 3.9 billion last year first half to 1.7 billion. And profit attributable to the shareholders at group level, from 4 billion to 1.7 billion. Let me now move on to the balance sheet. Now here again, at high level, I updated that we had 16% growth in total assets from 700 billion to 816. And even in investment, similar growth, 12% growth from 146 to 164, mainly due to depreciation of the rupee that also contributed, that the devaluation also continued to have some impact in terms of investment growth. Gross loan book for the 6 months, we had 83 billion growth, again partly contributed by the rupee depreciation. Deposits, 93 billion growth. More than the depreciation there, I would say that the growth in deposits also helped to support our liquidity positions. And the total equity from 59 billion to 64. You may recall that the total shareholder equity last year was strengthened by the Tier 1 capital infusion of 9.5 billion in 2021, second quarter. And we also raised Basel II compliant, Basel III compliant Tier 2 debentures. In November 2021, we raised 8 billion. I think the timing was perfect at that time. That time we raised that at a very much lower cost than what we are seeing now. I think that way the timing was perfect. That would help in terms of improving our NIM, net interest margin, going forward. These are the financial performance investor ratios for your information. Naturally, the closing price per share, substantial drop from 68.9 rupees in the first half last year to 35. I think the price is hovering around that range, 36 rupees. Earnings per share also dropped from 20 to 9 rupees. These are all due to the share market also reflecting the country's challenging economic situation, the default situation, everything are reflected here. And ROE, again, substantial drop from 12% to 5.6, mainly due to the provision buildup that we did. And whilst the book value per share remains almost same at 165 last year versus 167, slight improvement from last year. However, group level, the value per share is 177 rupees. Price earning times 3.86, and price to book value. This is where the challenge is from 40 cents last year. The price to book value is at around 20 cents. I mean, almost all the bank shares, you would know that this is where it is around 25% kind of price to book value ratio. So we are no different to the market, but this is to share the situation with all our investors. And also this one talks about the capital and the liquidity position, two important ratios in the current context. The common tier 1 capital last year, this time at the end of June last year, it was 10%. However, this year it has come down to 8.63, mainly due to the growth in our asset book due to the steep depreciation of Sri Lankan rupee. Our capital, for that matter, any bank's capital is denominated in rupees. However, the dollar denominated assets, when they reprice at the current exchange rates, the asset growth, whether you like it or not, has gone up. So resulting a capital ratio basically coming down to 8.63. But I must say here that the minimum capital ratios for the tier 1 is 7%. Tier 1 capital ratio, regular ratio is 8.5. There again, I think we are above the minimum requirement. There was no need for us to go and tap the capital conservation buffer that the central bank announced. Technically, any bank can go and tap up to 2% more in terms of capital conservation buffer, given the current challenges. So far, there was no need for NDB to go and tap that. And this capital ratio is also without capitalizing the retained earnings up to the first half. We didn't go for an interim profit certification. We saw some banks going for that to certify. However, there was no need for NDB to go and do that. But as we move forward, second half, we might do that towards, depending on the requirement. But I think we are comfortable. We should be able to manage the capital level as of now. Total capital ratio, 13% compared to 15% last year. In terms of statutory liquid assets, I think we have been maintaining a good liquidity level at 21.57. And then statutory liquid asset ratio at 24.49%. In terms of liquid ratio, we are very much above the minimum requirement, the 100% requirement. We are at 241%. That has improved from the last year's 193%. And all currency liquid ratio also at a good level of 156% compared to minimum required of 90%. In fact, central bank brought the minimum requirement from 100 to 90, but despite that, I think we are quite well above that at 156%. And a net stable funding ratio, again, minimum required is 90%. We are at 117%. So in terms of liquidity wise, we are quite liquid and we are comfortable of that stance. Even in capital, as of now, we are quite comfortable. However, if we have to take further impairments and all in the investment side, we may have to look at getting into the capital conservation buffer. But that decision would be taken after the profit certification, most likely in September. Right, this is my last slide. The challenges and way forward, of course, the challenges are enormous in terms of managing the current high interest regime, also the liquidity challenges that the banks are having, and also I think we have overcome the foreign currency liquid challenge that we saw in the first half, especially in April, May, June time. Almost all banks in the country faced with quite a significant foreign currency liquidity challenge when these lines were taken out by most of the foreign banks after the country downgrade. And there were certain challenges with some banks defaulting on the foreign currency swaps. So as a result, there was a artificially created liquidity issue. But I think we have also come out, along with all the banks, I must say, have come out from that challenges, and we are quite comfortable in terms of having met all our commitments, the LC commitments and all. So that foreign currency challenge has now overcome. The next is basically managing the rupee liquidity. That also we are comfortable in managing that. But more importantly, the greater challenge would come in terms of credit quality, because at this high interest scenario, where even corporates or the SMEs paying 25+% on interest alone, when the economy on the other side is having a contraction, lesser demand, all that would lead to a significant impact on the serviceability of the debt. So that's where we are very closely monitoring, helping the clients, helping them wherever possible for genuine situations. On the other side, the leases and all, we had seen the value of the assets improving. That means even the recoverability also has improved, especially the vehicle leases, the values have gone up. And there are instances where customers come and cooperate, and even there is a additional equity available after disposing the value. You settle your loan, and there will be some excess cash given to the customer as well. So there are some pluses and minuses in both cases, but that's a challenging situation that we are managing. The other priority would be ensuring the asset quality is managed in these circumstances, and then more importantly, supporting our customers to maintain their resilience in these challenging times. NDB is a customer-centric bank. All our facilities all basically are provided with the intention of customer at the highest level. So whenever they have difficulties ensuring that they maintain their resilience, they have to maintain their staff requirements, all that. Some would take certain hard decisions as well when it comes to controlling such expenses. But I think the core business in providing them support in times of challenge, in times like this, will continue. And we would also continue to focus on keeping more liquid in these circumstances. So deposit mobilization is also a key area that we are focusing. So we have shifted some of these priorities, right? Earlier, where we are growing our asset book, I think we have redeployed those staff in providing either deposit mobilization or providing greater service, or even use those good credit knowledgeable staff into supporting the distressed customers in terms of restructuring, working with them closely and providing them solution. So we have redeployed and directing in to manage the situation as of now. Another key thing is preserving the capital wherever possible, rather than going for the high risk-weighted assets, moving towards low risk-weighted assets and maintaining the risk-weighted asset portfolio, so that our capital ratio would continue to be not be burdened with great asset growth. And whilst all that being done, ensuring that wherever possible, giving a reasonable return to the shareholders. So that's a challenge that we all are having, but I think we are comfortable with you, and we have a very understanding holders who are supporting and at the right time to support and grow the balance sheet later on. Most likely once the country agrees with the IMF on the correction that we are working on, the IMF delegation is here, and how we agree on that debt restructuring, the sustainable debt structuring arrangement. And once that is done, we do understand there are various DFIs also willing to support the banking sector. And I think they're all waiting for this successful debt structuring. So that basically ends our prepared presentation. And now I leave it open. The chat option would be now open for you to pose the questions. And thereafter, we will answer those questions. Along with me, there'll be my leadership team, who, as I introduced earlier, would be taking any questions. So over to you to raise questions, please. There, there's a question on there's a 28.6 billion loan growth for second quarter. From which customer segments are these loans coming from? So they want to know whether it's from the working capital or capex related. I must say, I think bulk of that loan growth is due to the exchange impact, the depreciation of the rupee. So the dollar denominated loans had shown once it revalued at the rupee rate, higher rate. But in terms of, but despite that, in the first quarter, we had a slight loan growth, mainly coming from the corporate side and also the retail side. And those are no capex. Actually, we were not making any commitment on the capex, mainly on the working capital side. That's another question. How are the variable and fixed rate loan proportions change? What is the bank's policy? What is the bank's policy on credit card issuance for the whole set of questions? Let me handle one by one. How are the variable and fixed rate loan proportions change? I think in the first half, there was no major change between the variable and fixed rate. So there was no change there. Second question is, what's the bank's policy on credit card issuance for the future period? Any restrictions for the demand? We don't actually, we don't want to go and expand as you used to do, but certainly there's demand from the upper segment of the card. So those we would continue to support. We had made certain adjustments in terms of new issuance, especially in challenging times. Easiest is to use a credit card, so that we are careful. So in identifying the right clients, we would still continue to grow on the right customers, but not on aggressive growth that we used to have about a year ago. And there's a question, what are the customer segments, corporate, retail, SME, that mostly impacted by current economic condition, loan moratorium and NPL, and view on 8% NPL ratio forecasted by Central Bank for the year 2022. Okay, so I think the customer segments, those who are mostly impacted, I would say first to get impacted are the SME sector, because they are basically at the grassroots level of the economic growth. And when the economy is showing negative growth, naturally they would be the first to get impacted. And most of the SME customers also, the borrowing levels are relatively high. So then when the interest rate goes up, they would be the first to get impacted. Retail, we have not seen much impact similar to SMEs. And corporate also not much of, because luckily most of our corporates, our funding is working capital. So when the business comes down, the level of working capital quantum would also come down. So since most of the exposure in the corporate sector and for certain extent even SME are working capital, not the term loan component, we had seen gradually their exposure also coming down, especially when they're unable to import as they used to do. If you monitor them properly and if you structure the facilities to ensure that they won't divert this funding to other segments like free overdraft or that way, I think that's why NDB has scored quite well. Whenever there's a drop in demand, we had seen a drop in their loan book as well. But with regard to the NPLs, yes, the central bank also have indicated their expectations. Naturally, because you have to understand that most of these customers who were in moratorium are coming out from their moratorium when the interest rates are very high. So for them to continue repaying that in a high interest regime, that could be the key challenge. So there will be a spillover effect of those in the moratorium, moving some of them to NPL. So that is why the regulator has also indicated some high NPL percentages. And we can't rule that out, especially in a negative growth kind of a situation with high interest rates, there can be a situation. So that's why I did mention that we also are bracing for this situation. We have also strengthened our remedial unit. We have set up a new remedial unit, preventing the clients going to NPL and trying to support them. So most of our high-end resources are now deployed in the remedial unit to ensure that we address it early rather than wait for the situation to get worsened. Going forward, what are the initiatives have taken to manage impairment mainly on moratorium effect? So I think I answered that the moratorium effect by setting up this remedial unit. That's the key initiative that we have taken. The remedial unit is now in force for the entire bank, both corporate, SME, project finance level, and also in the retail side, identifying the potential customers who can go into the more deteriorated credit situation, identify them early, have our most experienced RMs managing them, assisting them. So that is the key initiative that we have taken. That you can answer. So there's a question on reclassification of OCI debt portfolio to amortized cost portfolio that was taken in second quarter. And also how much of OCI portfolio was reclassified or to amortized costs. I would ask Suendrini, our Vice President Finance, to take those questions.
So all your queries are given in the published financials, note 6 in the interim financial statements. So the bank classified approximately 38 billion of the portfolio as a one-time reclassification to amortized cost. And with that, the impact to equity or the upside to equity was 6.6 billion. So as per financial statement disclosure requirements, we have disclosed all the information and you can refer the note for further information.
There's another question about what is the haircut you are expecting from ISB when arriving at the provisions. I think from none of the banks are expecting any haircut. That is, I must say that that's the stance taken by all the local banks are holding on to ISPs. And usually when these ISP restructuring are negotiated to ensure that the protection of the local banking entities, usually the creditors also, that's up to the negotiations. And usually the IMF would also get involved in such and trying to see the local investees are supported without having a major impact. So we are not expecting any haircut. However, as precautionary provisioning, entire banking industry has agreed on certain percentages. This has been agreed even with the CA Sri Lanka, the regulator. So I think even NDB also, the provision build-up that we are doing is in line with the industry what we have agreed. There is a question, how has the activity on the loan restructuring picked up? Given the economic environment, how much of the current loan portfolio would represent restructured loans? I think there are, again, the activity on the loan restructuring, we are heightening that activity. That's where the key would be, basically to be more proactive in restructuring them and supporting them. So that's why I mentioned that earlier also, by setting up this remedial unit, we are continue to do that consciously by proactively supporting these clients. There's a question again, what is the variable versus fixed loan composition at the moment, and also the corporate SME retail breakdown? I think I have been repeatedly sharing this information. corporate, SME, and retail are equally distributed. So I would say about one third, maybe SME slightly lower, and variable versus fixed. There again, almost all corporate and the SME exposures are at variable rates. The fixed exposure may be around 50% of the project finance exposure. So that would be roughly about 10 to 15% of the book. That's a question. Has there been any provision made for potential local debt restructure? I don't think we have considered that. I think the central bank is very clear on that. You'd have seen the governor also making those statements. So we have not taken any provision for any local debt restructuring. Moratorium percentage now versus beginning of 2022, and also you all are expecting the moratorium percentage to increase with the new extensions. Certainly not. We had seen the moratorium exposure coming down, and you would note that the moratoriums are also completed by end of June. So there are no moratoriums now. Even for tourism sector, there are no moratoriums. So that exposure under moratorium would certainly has come down substantially. However, those still having difficulties, those would get restructured, and that is what we are doing now. But it's certainly not the level of the moratoriums. It would be much lower percentage compared to what it was in the beginning of the year. There's a question whether the ISP investments are at market value, which means a big part of the impairment hit is already taken. I must say that I think, yes, ISP investments are recorded at market value, but when we bought these ISPs, they have been bought at a discount compared to some of those others who have been bought at the nominal price. So there is an advantage of having them at having bought it at a discount. Any plans to modify the products mix to mitigate the risks of the volatile interest rate environment? Wherever possible, yes, we do modify the product mix, especially moving towards more better risk-weighted asset products in times of challenging times. That is one area that we are moving on. And wherever possible, the interest rate scenario as well, moving towards flexible interest rates. So some of those ALCO-related adjustments already made in terms of how we look at the business. But more importantly, rather than growing the asset book, it would be more on curtailing that only where necessary we support, especially the export-driven entities, SMEs who are suppliers to the export-driven industries. Wherever we have picked these industries where it would make a positive contribution to the economy, rather than maybe import-driven businesses. And that's where even these controls introduced by the government in terms of issuing a temporary ban on certain imports also is going to help in managing. One is the exchange rate, one is the country's total expenditure on imports in challenging times like that. So our product mix, our market focus also has been adjusted in line with these good intentions. Any other questions? These are the questions that we have received so far. That's question on how do you tackle with the reduction in liquidity position? SLAR reduced to 21%, which is 27% in second quarter 21. and what is the plan on growing deposit rates. Certainly, that's why our focus would be, we want to be liquid in the market. So when you want to be liquid in the market, naturally, we may have to pay some higher price, but on the other hand, we have seen so many state banks are paying quite a big high rates. So this is where the investment that we made in terms of digital channels, and also the investment we made in terms of deploying our privileged banking clientele at most of the branches. Actually, that has helped us to get more granular deposits. So rather than going for big ticket numbers, our strategy has been to go for more granular retail deposits. Though it takes time to get them, I think we have a very good loyal customer base. This way, again, the family banking concept that we have deployed, the customer centricity, all that has helped. And again, the group, the investment options that are available in terms of wealth planners, wealth funding, all that are going to help. So I think through NDB's one solution that we can provide it, customers also have the ability to move in their funds within the different options available. All those would help to be liquid in a situation like this, rather than simply going behind term deposits and get them. So that is the strategy that we have deployed, to be more liquid and manage the situation. Okay, these are the questions that we have received so far. And since there seems to be no other question, that we would conclude this webinar. I would like to thank all of you for taking part, and at NDB has been doing this quarterly webinar over the last 5-6 years as part of our investor relationship management, and we would continue to do that. And thank you so much for coming in and asking questions and being part of this and paying your attention to that. Thank you so much. And with that, we will conclude the webinar for today.